When making the decision to begin investing, you want to keep in mind the type of strategies you'd like to use, how much money you're comfortable with, and what type of an approach you're looking to follow. I'm going to look a bit more at what active investing is in comparison to passive investing. Hey guys, just Vish here. So I hope you guys enjoyed today's video, and if you do, please give me a thumbs up, subscribe if you already haven't, and I'll see you guys then. So first, let's take a look at what active investing is. Active investing is when you essentially have a hands-on approach, you're managing your buys and sells, and you think that you can basically beat the market and that you have an advantage in doing so. One story that's very well known of someone that followed an active investing strategy is that of Peter Lynch. He managed Fidelity's Magellan Fund between the years of 1977 and 1990. Through doing so, he was able to get investors a 29.2% rate of return. That was virtually unheard of. But knowing that there was such a high reward, we also need to keep in mind that there was an equally high level of risk. Lynch knew exactly what types of stocks to pick, buy, and sell, and doing so allowed him to experience the most benefit. On the other hand, looking at a passive investment strategy is essentially when you buy and hold for a longer period of time. You limit the number of transactions that occur on a daily or quarterly basis to almost minimal amounts, and you hold for a longer period of time. Through following a passive investment strategy, an individual essentially tracks the market, where through an active strategy, they're trying to beat the market. So a passive investor is someone that typically has a bunch of index funds, ETFs, and more passively automated investments. So first, to take a look at the pros behind an active strategy. The most important one is that you have a heightened level of flexibility. Through doing so, you're able to decide if you want to continue holding your position, if you want to sell, or if you want to buy more. Having this level of flexibility, you can either average down a stock that seems to be plummeting, or you can even purchase a stock that you want to gain more shares of. On the other hand, you also have the ability to exercise different options, such as short selling or pegging it against a certain time frame. You have a level of flexibility that doesn't necessarily exist with a passive strategy. Now, looking at the pros behind a passive strategy, you incur next to no fees because there aren't that many transactions that take place in comparison to an active strategy. With the low fees, you save money over time, and all of that can potentially be invested as well. Further from that, because you're not necessarily completing a transaction every single day, at the end of the tax year, you don't have that many capital gains that you need to declare as taxable income. So through doing so, a passive strategy allows you to essentially set that off for a later time frame. Now, looking at the disadvantages behind these two different strategies. When you are an active investor, you're taking an active approach to trading or investing, and you often incur a lot of fees. These fees will tend to add up over time, and at the end of the day, that's money that you could have spent investing in your actual strategies. Further from that, active risk. So you may have made a call where you thought a stock was going to increase over time, but because you ended up buying it, maybe you saw that the stock actually ended up decreasing. And the inverse is completely true as well, where you thought a stock was going to decrease, and so you wanted to pull out and sell everything, but you see it all end up increasing. So there is that bit of active risk that comes with not knowing exactly what's going to happen through active trading. Now, looking at the cons behind a passive strategy. Given that it's a very passive approach and that you're tracking the market over time, that sort of is by definition what it's going to do. You may not end up making the most significant profits, but you're essentially averaging out over time. Further from that, your options are a bit more limited because you're not making active trades almost every day or even every quarter. So through doing so, your options are fairly locked in and you may be limited to a particular set of ETFs or index funds that are almost predetermined. Finally, determining what works best for you. Whether you want to be an active strategy follower or a passive strategy follower, it's entirely up to you. How much risk you want to take on, what your time frame is, how much knowledge you have, and how much effort you want to put in. Above it all, my personal advice that worked best for me was diversifying. I wanted to try a bit of both so that I could spread my risk a little bit further. Through doing an active approach in terms of buying the Apple stocks and the Tesla stocks and all that good stuff, yes, there was a bit more risk, but I found the reward to be a little bit better and it paid for itself. But following a passive strategy through purchasing the good old Vanguards and all of those ETFs, you're essentially averaging it out and tracking the market over a longer period of time. I hope you guys enjoyed today's video. Please give me a thumbs up if you did, and if you learned something new, subscribe for next time as I'll be making a couple more of these videos and I'm learning a lot as I go as well. I hope to see you guys next time. See ya!